600%. That is how much a dying wool sneaker company's stock jumped in a single trading session. In what felt like an overnight maneuver, Allbirds went from a struggling footwear brand that had lost 97% of its value to reinventing itself completely. Today, the company is called Newbird AI. They sold off their entire shoe business for $39 million, secured a $50 million convertible note, and announced they are now a GPU-as-a-service cloud provider. They have no data centers. They have no AI engineers. They have no compute customers. What they do have is a public ticker symbol on the NASDAQ. And in the 2026 AI market, that ticker symbol was enough to send their valuation rocketing from $21 million to nearly $160 million overnight. This is the story of tech's craziest pivot. Is Newbird AI a brilliant, pragmatic survival strategy to capitalize on the global GPU shortage? Or is it the ultimate sign that the AI bubble has reached its absolute peak? To understand how a company goes from merino wool to machine learning, you have to look at what they were actually selling in the first place. Before the AI pivot, Allbirds was the darling of Silicon Valley. Founded by a New Zealand footballer and a biotech engineer, they launched a single hyper-focused product, the Wool Runner. It was marketed as the world's most comfortable shoe. But more importantly, it was the exact right product for a very specific cultural moment. The laces were recycled plastic. The midsole was made from sugarcane. The brand locked in B Corporation certification from day one. Silicon Valley executives ate it up. Larry Page wore them. Barack Obama wore them. It became the unofficial uniform of the tech professional class, a quiet, logo-free signal that you cared about the environment but still wanted premium comfort. They didn't just build a shoe company, they built a direct-to-consumer narrative. And the market rewarded that narrative. In November 2021, Allbirds went public at a $4 billion valuation. For a brand built on a single wool shoe and a sustainability thesis, it seemed like the ultimate validation. But there was a fatal flaw in the architecture. Products and supply chains can be copied. Sourcing merino wool is not a true strategic moat. And as we would soon see, a direct-to-consumer sustainability story is not enough to hold up a $4 billion market cap when the hype starts to fade. The public markets are an unforgiving place for a company built on a single footwear trend. Once public, Allbirds faced immense pressure to demonstrate continuous, endless growth. To satisfy Wall Street, they expanded aggressively. They opened 60 physical retail locations, abandoning the lean efficiency of their original direct-to-consumer model. They launched new product lines, diluting the focused, simple brand identity that had made them famous. As the macroeconomy shifted and the post-pandemic retail boom cooled, the arithmetic stopped working. Margins compressed, customer acquisition costs soared. The original Silicon Valley cohort had saturated, and mainstream buyers weren't willing to pay a premium for eco-friendly wool. By 2025, revenue plummeted. From a peak valuation of $4 billion, the stock fell steadily month after month. The company was burning through cash with no clear path back to profitability. They brought in new executives and instituted massive layoffs, but the structural damage was done. In early 2026, Allbirds was trading at under $3 a share. Its market cap had cratered to just $21 million. The comfortable, sustainable dream had evaporated, leaving behind a hollowed-out corporate structure. They had completely hit the wall. But what the executives realized was that while the shoe business was dead, the corporate shell still held one incredibly valuable asset. When a business fails, the traditional path is bankruptcy. You liquidate the remaining assets, pay off whatever debt you can, and dissolve the company. But Allbirds executed the maneuver straight out of the speculative markets playbook. They didn't dissolve. They stripped the house down to the studs. In April 2026, the board completely abandoned their original mission. They sold the entire footwear business, including the brand IP, the shoe inventory, and the retail leases to American Exchange Group for a mere $39 million. They stripped their public benefit corporation status, essentially waving goodbye to the ESG narrative that defined their rise. But crucially, they kept the publicly traded NASDAQ ticker symbol. In the 2026 market, a functioning, fully compliant public shell is highly coveted. It offers a blank canvas, a financial vehicle that can bypass the brutal, time-consuming IPO process. By selling off the shoes but keeping the corporate entity, Allbirds laid the foundation for the ultimate strategic reset. They weren't trying to save the footwear business anymore. They were searching for the hottest, most capital-rich sector in the global economy. And in 2026, there is only one industry that fits that description: artificial intelligence infrastructure. The announcement hit the wire like a shockwave. Allbirds rebranded its corporate entity to Newbird AI. They revealed a $50 million convertible financing facility from an unidentified institutional investor. The explicit purpose of the capital? To buy high-performance GPUs, spin up massive server clusters, and offer GPU as a service to a market desperately starved for AI compute. Wall Street's reaction was instantaneous and entirely irrational. Within hours, retail traders and institutional algorithms pattern-matched the word AI in the press release. The stock skyrocketed. It went from under $3 to over $20 in a single trading session, an explosion of more than 600%. To put that in perspective, that is a larger single-day move than NVIDIA saw in all of 2024. It didn't matter that Newbird AI currently possesses zero deployed hardware. It didn't matter that they don't have existing compute customers, or that the former executives of a sustainable shoe company have absolutely no operational experience managing liquid-cooled data centers. The market wasn't buying a proven business model. It was buying a narrative. In 2026, compute demand is genuinely outpacing supply. Data center vacancy rates are at historic lows, and high-end GPU procurement lead times stretch out for months. Newbird AI correctly identified a macroeconomic bottleneck, attached their public ticker to it, and instantly tapped into the most powerful force in finance: the fear of missing out. So what is the actual lesson here? Is Newbird AI the blueprint for corporate survival? Or is it a glaring red flag for an AI bubble? The reality sits somewhere in between. When a company's core business fails completely, returning capital to shareholders through liquidation is often pennies on the dollar. By leveraging their remaining public shell, the executives and their institutional backers essentially bought a $50 million lottery ticket into the cloud infrastructure space. If they actually managed to procure the GPUs and lease them out, this could go down as the most brilliant pivot since Riot Blockchain pivoted from biotech to crypto in 2017. But the real lesson isn't about data centers. It's about how financial markets reward storytelling over fundamentals. In periods of extreme technological hype, placing the right buzzword next to a ticker symbol generates more instant value than years of supply chain optimization. The market is happy to vote long before it has to think. Allbirds proved that a powerful narrative can build a $4 billion shoe company. Now, Newbird AI is testing whether a new narrative can build a cloud empire out of thin air. Which strategy could you apply to your work?
Learn the next winning strategy.